Hello, my name's Tim Price. I'd like to share two slides with you today. The first is our old friend really. This is the S&P 500 and this is what's known as the Shiller PE. So this is something that Robert Shiller does. He's a professor in behavioral economics at Yale. He takes the 10-year smoothed average of earnings for the S&P 500 and he plots them back, going all the way back to, in this case, 1870. So you've got 150 years worth of data here. Bottom line, US stocks, US large cap stocks are at their second highest level in history. We are way higher than we were in 1929. We are higher than we were in 1987. And the only market that rivals where we are now is basically the first dot-com bubble, which as we know ended in tears. So there is every reason to take this chart with, well, just, let's say to take it extremely seriously. Now, we know for a fact that one aspect behind the S&P 500 performance has been the so-called fangs, the likes of Facebook, Amazon, Apple, Netflix, and Google. One by one, those stocks technically are getting taken out and shot. Secondly, there is a growing concern that you're going to see some regulatory pushback given the importance of the data that they now control. I'm not saying the market is going to collapse. I'm merely saying that anybody who is buying the S&P 500 now has heroic expectations about future market returns. A Shiller PE of 33 times is unsustainably high in my view. If we move on to the second slide, it's not all doom and gloom, we've got some positive news too. This is a slide from Research Affiliates they did about 2 years ago. This is a breakdown of exactly the same market, the S&P 500 stock index, going back 50 years, 1967 to 2016. They've broken the market down into four characteristics: value, momentum, quality, and growth. And here's the amazing stat from this analysis. Two stock sector characteristics make money relative to the market over the long run, if the last 50 years is any guide. Value adds money relative to the market. Momentum, trend following, adds money relative to the market. That's the good news. The not so good news is that quality and growth detract from the market return. Again, we're making the same point. If you're in quality and growth, you need some fairly heroic presumptions about future returns because the chances are you're going to be disappointed. If you believe in mean reversion, which I do, then there's a clear need, I think, defensively to focus on value now, but also on momentum. But if you believe in the other two, then you're believing in magic. I would much rather believe in maths.